Great. So good morning, good afternoon, good evening, wherever you are. On behalf of the African Development Bank, the Egyptian Academy for Scientific Research and Technology, the Tamnia Watwatir, Egypt's Entrepreneurship Development Project, and iGravity, it's my pleasure to welcome you to today's webinar. My name is Lucas Can. I'm the head of advisory and partnerships at iGravity, and I have the honor to be your host for this webinar today. Before we go into the details, let me make you aware that you have the possibility to choose a secondary audio channel in which you will be hearing the presentation translated into Arabic. There should be a small button at the bottom of your Zoom menu called Interpretation. There is also a screenshot and hopefully a good indication in Arabic where to find this button. Please also note that this webinar is being recorded. So if you if you don't agree with that, please leave the webinar again. We will be spending the next 90 minutes speaking about the potential and challenges of innovative financing for startups in Egypt. For that, we have created the following agenda. First, we will be hearing opening remarks from Dr. Jehan El-Sokhari, Principal Socio-Economist at the African Development Bank, and Dr. Mahmoud Sakhr, President of the Academy of Scientific Research and Technology First. Afterwards, my colleague Anne-Catherine Buchwitz-Dessen, Associate at iGravity, will be presenting us the highlights of the study mandated by the African Development Bank and conducted by iGravity. The core part of today's webinar, though, is a panel discussion with national and international experts and representatives of the startup ecosystem. To lay the foundation for a fruitful discussion, my colleague Alejandra Baigun will give us a general overview to innovative financing mechanisms for startups. We will conclude after 90 minutes with final remarks from Dr. Jehan El-Sokhari. Please note that given the large number of participants, we have limited the utilization of the microphone to presenters only. If you wish to ask questions, and we encourage you to do so, please use the question and answer box, the Q&A box, that you should be able to find at the bottom or at the top of your Zoom menu. I am now handing over to Dr. Jehan El-Sokhari, followed by Dr. Mahmoud Sakhr for their opening remarks.
Thank you. So welcome everyone. It's lovely seeing that we have 56 participants, 58 participants now to today's very important webinar, which is on innovative financing mechanisms for startups in Egypt. Now, on behalf of the African Development Bank, it's a pleasure to welcome you all. I'd like to just give you a very brief idea on how this study was initiated and so forth. This study was initiated under the policy component of the African Development Bank's project entitled Tanmiyya wa Tatweer, which is implemented by the Academy for Scientific Research and Technology. Tanmiyya wa Tatweer itself is part of a larger regional program at the African Development Bank, which is called Souq al-Tanmiyya. And this regional program has country projects in Morocco, in Tunisia, and in Egypt. Souq al-Tanmiyya regional program is financed through a generous contribution by the Danish government, specifically the Danish Arab Partnership Program, for which we are very grateful. So back to the webinar of today. Today's webinar basically focuses on specifically on financing for startups. We know that startups are booming in Egypt. I think Egypt is the fastest growing country in terms of startups. Startups are also very different from SMEs. They are different in terms of their structure, in terms of the services they offer, in terms of the growth path they have. and accordingly, they're valued in a very different way. Hence, funding, the conventional funding mechanisms that are used for SMEs are not the best suited for startups. Definitely debt through loans is not the preferential or is not the best practice in terms of financing for startups. And financing through equity or through shares is good, but it also has its shortcomings. So under Tanmiyat Tatweer, we decided to look into this topic more deeply. And we commissioned a study that was undertaken by iGravity, a Swiss firm based in Switzerland, and today represented by Luca and Anne-Catherine, who are with us. And the study basically looked at the entrepreneurship ecosystem in Egypt. It looked at the opportunities and the challenges. It also looked at best practices, innovative financing mechanisms around the world, and made specific recommendations for Egypt. As you will see, we also have experts that have used these innovative mechanisms in Ukraine, the UK, and Kenya with us. Now, before I end, I just want to say that during the study, iGravity was assisted by a sounding board of Egyptian experts from the ecosystem. And these experts worked hand in hand with iGravity, reviewed the recommendations they made, commented on them, and vetted them. And hence, I would like to acknowledge them. The sounding board consists of Dr. Ayman Ismail of AUC Venture, Dr. Dalia Ibrahim of EdVenture, Dr. Heba Shaheen, the Executive Director of IRADA, Mr. Islam Yassin, founder of Napata, Dr. Luay Shawarbi, attorney at law, Dr. Lamia Al-Ayyubi, professor at New Giza University, Ms. Nermina Tahri, an MSME and entrepreneurship expert, and Ms. Rania Ayman, founder of Entrepreneur. Last but not least, of course, I'd like to thank Dr. Mahmoud Sa'r for his personal engagement in this project, as well as to the fantastic Tanmiyat Tatweer team that is led ably by Ms. Shayma Hilal. And for this specific study, I'd like to also acknowledge the efforts by Ms. Inji Naguib, the project coordinator, without whom this would not have happened today. So without further ado, back to you, Luca. Thank you.
Thank you very much, Dr. El-Zakari, and I can only echo what you said. I'm now handing over to Dr. Zakir.
Okay, thank you very much. A very good morning, everybody. My dear colleagues, Dr. Jihan Al-Sukkari, my dear colleagues and friends, experts from Kenya, from Ukraine, from United Kingdom, dear colleagues, Ms. Shayma Hilal, Director of Tanmiyat Tatweer Project, and all the crew of Tanmiyat Tatweer Project. It's really great pleasure and honor to attend the opening of this very important event. First of all, let me emphasize that Tanmiyat Tatweer is one of the most important actually project given to the Ministry of Higher Education and Scientific Research. It's not only related to the fund, it's related to capacity building and helping the Egyptian STI community, innovation ecosystem, entrepreneurship ecosystem actually to find and to learn and to share experience with other countries around the world. First of all, thanks to the Multi-Donor Trust Fund for Countries in Transition, thanks to Danish-Arab Partnership Program, thanks, of course, to African Development Bank for giving us this opportunity actually to post the entrepreneurship ecosystem in Egypt and to learn from experiences of other countries in this regard. The importance of Tanmiyat Tatweer also for the Egyptian innovation ecosystem in Egypt is also due to the specific objectives of the project. Of course, you know better than me that the strategic objectives of the project is to support the entrepreneurship ecosystem in Egypt, but also through different work packages and milestones related to supporting incubator, accelerator, some studies, and establishing also a platform. And today we are speaking about one of the two studies which actually will be implemented through this project. The study related to innovative funding mechanisms of startups, which is a big issue in Egypt. Let me say or share with you the experience of the Academy of Scientific Research and Technology in Egypt in supporting startups in Egypt. We started actually our activities to support startups through establishing a national network of technological incubator called or named Intilaq. Now we have something like 30 incubators all over the country. We also supported the establishment of a national network of entrepreneurship clubs in more than 30 Egyptian universities and research centers. And through these e-clubs, our partners in public and private universities provided training to more than 28,000 students. We also support the entrepreneurship ecosystem through launching long time ago a very big national network of technology innovation and commercialization offices called TAICO. We did a lot. The government also of Egypt during the last few years invested a lot to boost the innovation ecosystem in Egypt through new funding mechanisms, establishing of new funding entity, for instance. Last year, only a new entity to fund innovation in Egypt was established, belonging to the Ministry of Higher Education and Scientific Research. This new entity called Innovator Support Fund, or ISF Egypt. And the money of this new fund is not from the public money, it is a part from the revenue of some public universities and private unit affiliated to some Egyptian universities and research centers. So the government invested a lot. The Academy of Scientific Research and Technology launched a lot of initiatives actually to boost the entrepreneurship ecosystem in Egypt. But to be honest, from technical point of view, we met some problem and the challenges. One of the most chronic challenges is funding of startups, how to manage. I'm very happy and eager to listen to the recommendation of this very important study. I'm very eager to learn from experience of our colleagues in Kenya, United Kingdom and Ukraine. Would like to know in more details how to apply the proposed new and innovative funding mechanisms to startups in Egypt within the governing rules and situation in Egypt. Looking forward actually to learn from our colleagues. Taking this opportunity, I reaffirm our thanks and appreciation to the donors. I reaffirm our thanks and appreciation to the expert participated in this very important study. Special thanks and appreciation to my dear colleagues, Dr. Jahan Sukkari and Ms. Shaima Hilal. Thank you very much, and I wish you a very fruitful discussion. Thank you very much.
Thank you very much, Professor Sacker, for these very kind introduction remarks. I will now hand over to my colleague Ann-Kathrin Buchwetz-Dessen, who led the development and editing of this study, and she will present us the highlights. Ann-Kathrin.
Thank you, Lucas. So, as already outlined by Dr. Shahin and Dr. Mahmoud, this study is a small but very important piece of a much larger project, the Egypt's Entrepreneurship Development Project. And Lucas, you can please move to the next slide. So to give you an introduction to the objectives, the process, and the outputs of the study, The study will assess which innovative financing mechanisms that may be relevant to the Egyptian context, and thereby it will contribute to a more diverse and flourishing enabling environment for startups as well as investors. The study was conducted in 4 phases. The 2 first phases focused on Egypt and sought to identify the needs of startups along the startup cycle, as well as understand the shortcomings of the existing financing structures and dynamics. The 3rd phase looked beyond Egypt in identifying existing examples and best practices of innovative financing mechanisms that could be suitable to the identified needs and context in Egypt. And lastly, this 4th phase that we're in now will summarize the findings of the study and make recommendations on how Egyptian actors, especially you here today, can enhance the use of innovative financing mechanisms in Egypt. So the purpose of the webinar today is really to enrich these recommendations through the discussion that we will have later, and to spark the interest among you, the key actors, to carry this vision forward and to bring it to life. So as such, the best practices will be outlined in the study and in the study recommendations, and together they will provide guidance to you, the enabling actors, on how to use innovative financing mechanisms in Egypt. But additionally, the study will also provide a toolkit for startups on the objectives, the suitability, the benefits, and the steps for accessing these innovative financing mechanisms. Next slide, please. And before we move into the key findings of the first phases of the study, I just want to underline that when we speak of startups in the study, we refer to ventures that are typically newly emerged and growing businesses. This is in contrast to MSMEs in a broader sense, which may have no or very low growth ambitions. However, at the same time, I'm also not insinuating that all startups are high growth unicorn archetypes. So the study focuses on startups with some growth ambitions and scale potential, though these can be both modest and high growth. And then to the findings that has guided the selection of innovative financing mechanisms. Next slide, please. Good. So with regards to the findings on the startup level, we see a very diverse pool of startups, both in terms of stages, sectors, growth projections, and to some extent also geographies. And therefore, naturally, there is also a very diverse financing needs. We see relatively few, but a growing number of startups that are branded as impact and social startups. And we see that startups generally experience very high costs of both debt and equity capital. On the financial intermediary and investor level, we are super thrilled to see the exponential growth in VC activity and volume since 2015 and until now. But we also recognize that it seems that the majority of the capital is directed to few and mostly unicorn archetype startups, and that there is limited diversity in the mechanisms applied. In addition, several early stage investors has voiced that they experience a lack of liquidity events or secondary markets in general, which limits their ability to recycle invested capital. On a regulatory level, we are equally thrilled to see the changes that has been both formulated and implemented during the last decades, as well as the improvement foreseen in the near future, including a designated regulation on crowdfunding, for example. At the same time, we can understand that there is a mixed perception on the degree to which some of these changes really cater for startups versus more mature MSMEs, at least in practice. So altogether, we can see that there is a significant potential to implement innovative financing mechanisms which leverage the recent VC capital growth, built on the increased motivation and ability of financial institutions to serve MSMEs, and tap into the improving regulatory environment. So thereby, by implementing new innovative financing mechanisms, we hope that we can contribute to addressing the limited availability of both affordable and diverse financing for startups. Thank you.
Sorry, need to unmute myself. Thank you very much, Ann-Kathleen, for this short overview. I want to remind the audience that you can always ask your questions in the Q&A box, also with relating the study or what we are about to hear next. So now I'd like to hand over to my colleague, Alejandra Bargun, for an introduction into innovative finance mechanisms for startups.
Many thanks, Lucas. Let's go over to the next slide. So let's think about what we mean when we use the words innovative finance. So in this case, we are referring to solutions that channel different sources of financing, be it public, private, government, financing seeking market returns, lower than market returns, all of these financing sources towards solving pressing global issues. So what does innovative finance usually entail? It's about mobilizing capital, so new capital financing. It's about making the financing more effective. It's about de-risking. It's about combining or blending different sources of capital, such as private and public, together. So how can we apply innovative finance for startups? We can use innovative finance mechanisms both at the investor or intermediary level, as well as at the startup level itself. So at the investor level, how can we help channels more financing from different sources towards startup? We can lower transfer risks by providing risk coverage or guarantees. We can provide incentives for investors to finance even more startups. We can reduce transaction costs of investing in these startups. We can increase the liquidity of the startup market. This means that if investors buy shares of the startup, they know that then there is a market for those shares, and there will be other investors interested in buying them when the company grows. So going to the company level options, how can we help the startups raise more financing from different sources? We can increase the expected returns and make them more attractive for investment. We can find alternative types of collateral to help them reduce the investment risks and access more financing. We can help them raise financing despite maybe unstable or unpredictable returns by allowing for flexible repayments to investors. And so many of these options, we have tried to illustrate them in the next slide, which is innovative financing in action at an ecosystem level. So if you see below, we have the startups, and we can see that they go through different stages of growth with both different financing and non-financing needs along their life cycle. So how do these startups, be it at different stages, how do they get financing? So here we have illustrated two types of instruments. If we look at the lighter gray ones, these are the traditional finance instruments. And then in the darker gray ones, we have included innovative finance instruments. And what is happening at the level of the organizations that provide capital to startups? This is the green layer, where we have public, private, third sector resources. And so we want these organizations to increase their financings to startups and to use different sources of financing as well. So here we also have the ecosystem enablers, which are the organizations in the top blue row. And these are key as they provide innovative financing to help these organizations below mobilize more and more capital to the startups that are below. And here we have also illustrated some of these mechanisms as well. And so while at a first glance, you might be a bit overwhelmed by all the potential at an ecosystem level, what I want you to take away from this chart is that innovative finance mechanisms first can be applied at both levels, both at the investor or intermediary level as well as at the startup level, and to really keep an open mind about the many ways these mechanisms can be used. So let's go on to the next slide. And let's quickly go through 3 nondefining mechanisms that are analyzed in the study, and that you will later see some real examples of this mechanism from hearing from the experts and practitioners. So what are these mechanisms? We have revenue sharing agreements, we have crowdfunding, and we have social impact incentives. So I'll quickly describe each one. And so let's start with the first. So what is a revenue sharing agreement? So this is a structure in which investors provide financing, for example, debt, and instead of having a repayment schedule in installments, under this contract, the startup will be paying back the investor a percentage of its revenues. So what is the purpose of this mechanism? This will help the startup, especially those that do not have collaterals, such as building, equipment, or other assets, to be able to access financing. And a really interesting highlight of this mechanism is that it can help startups reduce the debt burden, especially in times of low revenues or fluctuations, thinking about, for example, with the current pandemic and what this meant for many startups. So let's move on to crowdfunding. So what is crowdfunding? Crowdfunding is a tech-enabled way of raising funds for different projects or entities where a group of funders pools their capital onto a platform to provide financing. So there are 6 types of financing that can be made through crowdfunding. We have donations, rewards, royalty, equity, debt, and hybrid models as well. And the special thing about crowdfunding is that it provides public access to investments, to invest, in organizations, and it can contribute actually to democratizing both the supply as well as the demand for financial investments. This, on one hand, is improving the liquidity of the startup market as well as the cost of capital, so lowering the cost of capital for startups. And the last mechanism is social impact incentives. So these incentives, sinks, are a funding instrument that is rewarding high impact enterprises with premium payments that are deployed only if the company can achieve some specific predefined impact outcomes. And these outcomes are additionally verified by a third party. So these incentives, these sinks, can be provided both to individual startups, companies, as well as financial intermediaries, which is very interesting in the context of Egypt. Because, for example, these sinks could be used to incentivize financial institutions to work with more smaller companies and startups as part of their portfolio. And these incentives would be really important because normally for these financial institutions, there might be higher risks or higher origination costs of working with startups and smaller companies in general. So let's move on to the next slide. And I guess so here these sketches are illustrating the formats in which the 3 financial mechanisms work, but I'll move on as you will hear from real cases of each of these mechanisms. Thank you so much, Lucas. On to you.
Thank you so much, Alejandra, for this short but precise introduction. Now we will move on to the core part of today's webinar. We have invited 4 organizations that have successfully adapted and used the innovative finance mechanisms just introduced by Alejandra beforehand. Now each organizations will be sharing their learnings from the usage and hopefully inspire Egyptian startups and other stakeholders to follow their example. We will start the presentation round with Lewam Kefela, Investment Director at Village Capital, who will be speaking about revenue-based financing.
Hi, everyone. Great to be here with all of you today to be talking about revenue-based financing. As a bit of background, I'm an investment director at Village Capital. Village Capital does a few different things. The first, we have direct entrepreneur support, where we support entrepreneurs through accelerator programs that are focused on investment readiness. The second is we have a family of funds management arm that I lead, where we manage a series of funds focused on investing in seed-stage, impact-driven startups through a variety of different vehicles and different financing mechanisms, some of which we're talking about today. And the last is through a platform and tools for ecosystem builders to support accelerators and investors with peer selection curriculum, milestone planning, and entrepreneur matchmaking. Next slide, Luca. So at Village Capital, we've been able to deploy a variety of different financial instruments to support entrepreneurs, largely because we recognize that the entrepreneurial journey is different for everybody based on what they are building and what sort of projections or expectations they have for their business and growth. So we've deployed both equity and non-equity instruments. So we've deployed convertible debt, equity, traditional venture debt, as well as revenue-based financing. And today I'll be talking a little bit about revenue-based financing. You can see some of our Village Capital results on the slide in front of you. So revenue-based financing. With revenue-based financing, there are 3 key terms that you should take note of. The first is the royalty or percent of revenue fee. The second is a return multiple or multiple of invested capital. And the third is the investment horizon. So those are the 3 key terms that we consider when we are investing with revenue-based financing. Standard terms for the percent of revenue that you charge as a payment is between 3 to 7%. What that means is, for us, we usually do it on a quarterly basis. So on a quarterly basis, we would charge the startup 3 to 7% of their revenues until we're able to return our investment times the return multiple. So to just kind of give a quick example, for instance, if we had a company that we put $100,000 into and our expected return multiple that we have on that investment is 2 times, then the company would pay, let's say, between 3 to 7%, let's say 5%. They'd pay 5% of their revenue on a quarterly basis until they pay $200,000. So that's typically how how revenue share-based investments are structured. The return multiples vary between 1.5x to 3x. As revenue share becomes a little bit more commonplace, we're seeing those multiples start to decrease. The investment horizon we typically expect with a revenue share is 3 to 6 years. And one of the ways that we've sort of managed really enabling the entrepreneurs to deploy capital and put the capital to work before we start making collections is to grant a grace period, which is usually about 6 months to a year based on where the company is, so that they're able to put the capital to work before we start taking collections. So why would someone use revenue share? There are a few different reasons. The first is revenue-based financing is non-dilutive. That means that it's not costing you any equity front, and in the long run, especially for startups that are looking for large equity exits, that's completely beneficial for the founders. So it doesn't create dilution for either founders or investors. The other point is, as I believe Alejandro mentioned earlier, revenue-based financing aligns incentives between entrepreneurs and investors. That means in periods of growth, the investor recovers more capital, and in periods of slumps, the investor recovers less capital. So unlike debt financing, which is like a very standard payment that's predetermined based on the interest rate and whether or not it's amortized debt versus like bullet venture debt, revenue share payments fluctuate with the amount of revenue that's earned in that period. So it's a little bit more forgiving with seasonal businesses particularly. We've found that revenue share works very well with businesses that are at profitability or close to profitability, largely because if there are some concerns around a cash constrained position, then it's very difficult to be able to make those payments as the company grows. If the company is not profitable, then it would need to be subsidized and has no view into profitability, then it would need to be subsidized by some other form of financing like equity-based financing. And then we've seen that it works really well for companies that have clear visibility into their projected revenues, like SaaS businesses, or even like companies that sell hardware but have very, very good visibility into what their revenue and demand for that would be. So yeah, that's been our experience with revenue-based financing. We've deployed it both in the US and in some emerging markets as well. And it's worked out well for us. We've also combined revenue-based financing with equity financing in a startup that we see as high potential. And so I think revenue-based financing is one of those mechanisms that can be combined with other additional financing mechanisms. Thank you so much.
Thank you so much, Lewam. I will now hand over to Gavriel Landau, CEO and co-founder at Charm Impact, together with Konstantin Boyko, CEO and co-founder at Lenderkit, and they will be speaking about crowd lending.
Hi, Lucas. Hi, everyone. Thanks very much. And that was a really interesting presentation just now on revenue-based sharing. So thank you for that. That is very, very insightful. So if we can just flick to the next slide, Lucas. Thank you so much. So my main message for today, and I'll explain what we do in a moment, but the main takeaway I want everyone to have is that the way in which we're going to use the term blended finance, which is another term for innovative finance generally, it should try, and this is what we try and do, to benefit everyone in the ecosystem. So it should benefit the investor, it should also benefit the borrower, and it should also benefit, in our case, and I'll explain that in a moment, the grant maker or someone with, let's say, a much more risk-tolerant approach. It's kind of my key message I want everyone to take away from how this can work. And it should work as an ecosystem from the outset, because I think a big learning to share is that a lot of incentive mechanisms are often skewed to one player in the ecosystem rather than looking at a holistic approach from the outset. So what do we do? So we provide blended debt finance to early stage, high impact companies, primarily in sub-Saharan Africa. And we've got one project in South Asia at the moment as well. Now, we generally are working with companies in the energy industry. And as a kind of classification, they are early stage companies, really at the earliest stage of commercialization, post R&D, but pre-scaling. So they're early stage businesses in challenging markets with new products and new business models. So they're very high risk from a traditional standpoint. And so therefore they often will fail the normal expectations of what is debt worthy, what is lendable towards. And I think the primary starting point is if we want to lend to them, we have to change our attitudes to what is an acceptable level of risk tolerance, be aware of that risk, and then use innovative finance to de-risk it. So what we do, and where to share some learnings, is we take a crowdfunding approach. So we have a crowdfunding platform, and my colleague Konstantin will talk much more about that in a moment. But we can therefore have a platform to bring together actors. And what we do is then we assess each company, and we determine, based on the level of risk, how much protection does the investor need, and how does that then benefit the borrower. So we take what is probably a relatively traditional macro fund principle of what's often called a junior and senior tranche. So we work out based on their credit risk, their impact potential, and their forecast impact and their operational performance to date. What does that look like? So I'll give you a practical example. We'll have a £100,000 loan for an entrepreneur in Nigeria, and we would charge our relevant interest rate to that. But based on their credit risk profile, we will say, okay, 35% of this loan should come from a more philanthropically minded source who's going to take the junior tranche. Now, what that means in practice is that the investors in that group are going to get paid back first. So you as an investor have protection in the event of a partial default. So in what they would call, typically it's called a waterfall model, investors get paid back first, their principal investment, then the investor's interest, then the junior tranche, which could be philanthropic, could be government grants, it's just more concessionary capital, that gets paid back next. And then the interest on that, if you choose to charge interest, and it's a critical point we'll come back to, then gets paid back last. So what does this do? It will generate financial and, for us, social returns, because we are focused only on high impact enterprises, and it incentivizes private capital to come into a market where they otherwise wouldn't be coming in. So let's say you are a government body providing a grant, or a philanthropically a foundation or something like that, taking that junior tranche, that first loss position. Essentially what's happening is you are bringing in, you're catalyzing that finance to come into a market where it otherwise wouldn't come near. So it starts with just 35% of that total, brings in the remaining 65%. But what's more, rather than just being a grant that essentially is used once and then disappears, this money is repaid in a really commercially viable manner, because that company is now building up a credit history and a credit score because they're paying this money back. So you are then able to get your money back, that 35%, to reinvest in more companies. Now that makes it a far more commercial outcome. And for us at Charm, our real focus is to get impact at scale. We need commercially viable businesses. So what do we create in the additionality? My final thoughts, right? We've got this money can come in as a first loss piece that creates the initial additionality of crowding in investors into a market they otherwise might not come into. So there's an incentive for them. You can offer discretionary interest rates to the borrowers as a result, because a portion of that capital could be from a concessionary source. The capital is then recycled, so it's getting even more like bang for your buck, if you will. And then the final point is you create additionality because you grow a business in a commercially viable manner. So you're nurturing them from a young stage, but with a credit history. They build up a credit score. So at some point when they're ready to graduate from smaller scale debt, they become loan worthy, let's say, and an investable propositions for more risk averse investors. And in that way, we try and create the entire enabling environment to achieve scale and impact, and they go hand in hand. I'll stop there, Lucas, but if there's any questions afterwards, more than happy to go through them.
Thank you very much. I will now hand over directly to your colleague, Konstantin.
Yeah, thank you very much, Lucas. Thank you, Gavriel, for a very inspiring presentation. And I will try to continue, but in a bit different direction. While Gavriel's presentation was very specific, and it was a very specific case study of using crowdfunding, or specifically crowd lending. In this case, I will talk more about diversity and different business models which can be covered with crowdfunding, and hopefully that will inspire you in Egypt to try and create those businesses and implement those financing models. But a little bit about myself. I'm Konstantin Boyko, CEO of LondonKit. But basically, in the first place, the company called Just Coded, which is a software company creating products for crowdfunding industry. And LondonKit is our main product, which is crowdfunding software, flexible enough to be modified for different business models, different jurisdictions, and regulatory requirements. And also we have a research project called Crowdspace, which is essentially the largest directory of crowdfunding platforms in Europe, where we collect all different types of platforms and categorize them, and also try to create a community around those platforms. So, Lucas, next slide, please. Yeah, so first of all, I'm trying to show that crowdfunding is a very diverse tool, so it can work with very different types of financing. And we basically define 4 types of crowdfunding: debt, equity, donation, and reward. I know that previously the presenter was talking about 6 of those, but we mainly work with those 4 because I think they are kind of more essential. And it is possible to combine those in one platform, in different platforms. And there are platforms specializing on very narrow cases, like the one run by Gavriel. But there are also very general platforms. And if you look at the UK market, for example, you will see Seedrs, Crowdcube, which are just a place for startups to go and get financing in exchange for equity. At the same time, you can find very niche players doing very, very specific things. What we see in different countries, because we work globally and we also do some market research, the size of the market and the level of development of crowdfunding is very tightly connected to regulations and how the certain governments work with entrepreneurs and how they allow them to start and try those innovative models. So, for example, in the US, there are regulations for many years already, and the market is already developed. There are big players. In the UK, it's similar. In Europe, in the European Union specifically, every country has their own different regulations, and the market is very fragmented. So that creates a lot of barriers for platforms. And at the same time, there is a very positive step recently, which is should be coming into effect in November. And so there will be pan-European regulations. What we also see in the Middle East, we work with companies in Saudi Arabia. They have a regulatory sandbox which allows them to try their technology, their business models, and we see that it's working well. So we've also been talking with some companies, with some entrepreneurs from Egypt who wants to start crowdfunding platforms. So the bottom line, I think, from my end, is that the potential definitely there for every country to use crowdfunding and create platforms which will eventually help startups to get financing. But what's also very important is that there should be open dialogue and collaboration between governments, regulators, and entrepreneurs who want to start those platforms. And when there is a dialogue, there is success, and then crowdfunding becomes a very powerful tool. Thank you very much.
Thank you very much. That was a very nice summary. I'm handing over, last but not least, to Etienne Ndatimana, Head of Product and Operations at AceliAfrica, who will be speaking about social impact incentives. I'm sorry for not correctly pronouncing your last name, as we went with first name all the time.
Yeah, thanks, Lucas. Yes, Etienne Ndatimana. Yeah, I'm joining this conversation from Nairobi, Kenya, representing AceliAfrica. So very similar to the mechanisms presented by the other panelists before me, that spoke before me, AceliAfrica equally applies a blended finance model using philanthropic and public funding to unlock private sector investment. So we are donor-funded market incentive facility aiming at unlocking financing for agricultural SMEs in Africa. Lucas, next. So just to take you a little bit back how we started. So we designed our solutions based on findings from numerous studies that had been done, indicating that there was an existing financing gap for agricultural SMEs in sub-Saharan Africa. For example, one study that was commissioned by KFW in 2018 estimated the annual gap for agricultural financing in sub-Saharan Africa at 180 billion. And 1/3 or 35% of these, or about 65 billion USD, was a financing gap just for SMEs with funding needs between $25,000 and $1.5 million. So we did a follow-on study between from 2018 and 2020, and we focus on that particular SME segment to understand the challenges that lenders face in serving these SMEs. And interesting findings. So the findings highlighted that transaction costs for sourcing and monitoring small agricultural loans, are higher than the revenues lenders would expect to receive from the loan, even when it is freely paid. So it didn't make economic sense for lenders to provide small loans. And then number two, the risk of lending to agriculture was also found to be twice higher, but returns were in the opposite direction. The returns are 5% lower than lending in other sectors. So which meant that, with two opportunities in different sectors, one ag, one non-ag, the choice is obvious. The lender will just allocate capital to the non-ag opportunity. So obvious, that shows, there is an opportunity cost, and this is where we come in. So we provide the subsidies, in essence, to unlock agri-SME financing. So ACELI interventions are to address the capital supply gap by offering financial incentives to the lenders. And these financial incentives include the first loss cover, which you can see it to mitigate the high risk, but also the origination incentives, which come in to defray the cost of providing small loans to agricultural SMEs. And to a limited extent, we also offer capacity building for lenders so they can learn how best to lend to agricultural SMEs. And on the demand side, we also provide technical assistance to SMEs so they can borrow and better manage the financing once they receive that from the lenders. So how do we do this? Lucas, go to the next. We do this by mobilizing funding from donor organizations. For example, just in the last 1 year, we have received over 30 million funding from the USAID, IKEA Foundation, Swiss Development Corporation, among other development organizations. And we deploy this funding, a large share of this funding, in the form of financial incentives to agricultural lenders. Currently, we are working with over 20 lenders in East Africa. These lenders include global social lenders, commercial banks, and non-banking financial institutions. So a spectrum of lenders targeting and serving different types of small businesses. Please note, we do not charge lenders a fee to join the program, but they have to set and meet some lending targets for them to stay on the program. So over the last 12 months since the launch of operations, we have enabled these over 20 lending partners to provide 20 million USD worth of loans to over 200 high-impact agri-SMEs in the East Africa region only. And almost half of these SMEs, that's important to mention, they had not received over 25,000 USD in financing before our intervention. So lenders, some of them lowered the minimum ticket sizes for them to serve these SMEs. And over 60% of the SMEs are gender inclusive, and 50% plus contribute to food security and nutrition. And that's the impact. So we look at the high impact businesses before we deploy the incentives. So as I conclude, I would like to illustrate briefly how origination incentives work. Look at the graph at the bottom of the slide. So in essence, an AceliAfrica partner lender will originate and then register with us eligible loans in the ticket sizes, in the ticket size range of 25,000 USD all the way to 500,000 USD or equivalent in local currency. First, once they register, we will verify if the borrower meets the minimum impact criteria in terms of jobs created and existing linkages with smallholder farmers. Once they meet those, are you employing 5+ full-time employees? Are you sourcing from smallholder farmers? Are you selling, say, inputs to smallholder farmers? Once the answer is yes, then the loan will be accepted with us. And we will then determine the amount of incentives to allocate to the lender based on the level of impact the borrower is generating. For example, as you see on the graph, if you look at the continuous line in blue versus the dotted line in blue, the dotted line in blue is same loan size, but then you can see the incentives are higher because the dotted blue line is giving us higher impact. So they are meeting 3 impact criteria, as opposed to the straight line that just giving 0 impact criteria, but at least it meets the minimum. So there is a minimum and there is a higher bar of impact. So we intentionally provide the higher incentives for smaller loans. If you look closely at this graph, you can see that a loan, at say 100,000, between 100,000 and 200,000, earns the highest possible incentives in absolute dollar terms. And then we phase down and out as we go to higher loans up to 500,000 USD. So what in essence am I saying here? So while our solutions are designed to meet a specific market segment, that we're mentioning SMEs, we believe a similar approach can be adopted to meet the needs of, say, startups. So different sizes of businesses, different sectors, it doesn't have to be ag only, and geographies. We're looking at Egypt. So what I work in East Africa could work with a tweak in Egypt. And what will success look for us, of course, is we're trying to see how more investment can go into the agriculture. We would want to see governments, investing more money in the sector as a percentage of the GDP of the country, and also private sector investors investing more in ag relative to their total investment portfolio size. Lucas, I stop there. Thank you.
Thank you so much, Etienne, and of course all the other presenters. I think this was very insightful. So now, after we have heard the usage of innovative finance mechanisms elsewhere, we want to understand where the potential lies in Egypt. To elaborate on this, it's my pleasure to introduce 3 distinguished panelists from the Egyptian startup ecosystem. First, we have Tamer El-Raghy, Managing Director of the Acumen Resilient Agriculture Fund, a 58 million impact agri-VC fund and the world's first equity fund designed to build the climate resilience of African smallholder farmers. Tamer has more than 20 years of private equity, venture capital, M&A, entrepreneurial and innovation experience in Africa, the Middle East, the US, and Europe. Next, we have Hussein Abou Bakr, CEO of Mozart Free, a leading digital community for farmers in Egypt. Hussein has over 18 years of hands-on commercial and operational experience in agribusinesses. He is a third-generation agribusiness owner and operator with a focus on high-value added products such as herbs, spices, and pickles. that are exported to the US and the European Union. Last but not least, we have Mostafa Ghaly, a consultant with a great deal of knowledge and exposure to the Egyptian regulatory, government, entrepreneurial, innovation, and investment ecosystems. Mostafa is currently supporting the Egyptian government in improving the business environment. Mostafa was responsible for leading a number of large-scale projects to enhance access to finance and support Egypt's digital transformation agenda. And he was also very supportive for conducting our study as well. So welcome, gentlemen. Before we start with the discussion, please let me remind the audience that you have the possibility to submit your questions to the panel. Please use the Q&A box, as already a few people have done. So let me start the discussion by asking Mr. Hussein Abou Bakr, of which of the three mechanisms do you find particularly interesting in terms of securing more and better suited finance for startups, and why?
Thank you, Lucas. Hi, everyone. Nice to be here with you today, and thank you for the lovely, informative presentations. I'm the founder and CEO of Muzera. Muzera means small farmer. It's an agri-fintech platform. I focused in the presentations and tried to understand them thoroughly. I'm inclined personally to two models, the social impact incentive model and the crowdfunding, but I needed to choose one which is more relevant to the Egyptian ecosystem. I like the idea about social impact, that it's measuring beyond monetary return. But I also found in crowdfunding that part of the crowdfunding comes from donations and grants, so it's more inclusive. So my final inclination, knowing and seeing what's happening in the vast growth in the Egyptian startup ecosystem, is crowdfunding mechanism. And this is for several reasons. When you're talking about donations, you're talking and grants. This already includes funds, international and local, that supports causes like financial inclusion, like gender equality, like environment protection and sustainability. So this part is already included in the crowdfunding model, and it provides the first protection and the first loss in the model of the crowdfunding. The second part is equity, which could be provided by both corporates and institutions as well as people. I get a lot of questions from family, friends, and people who know me, who are asking me, I have some cash and I want to buy a piece of land. I want to grow some trees, but I'm not free. I'm a corporate citizen. So there's a huge number of people in Egypt and outside Egypt who want to invest their money in alternative vehicles other than bank deposits and real estate. So I like this part. Also debt, mixing debt, equity, and donations and grants in one vehicle creates I like the idea of a hybrid model, which is more like represents our society, the society and the mix of people that we live with. As I told you, in Egypt, people hold a lot of cash, so a crowdfunding module would be perfect. It will also create a personalized relationship between investors and money providers and the entrepreneurs, which is very, very important in the beginning, to have interpersonal relationships between investors and entrepreneurs. What else? That's. I don't want to take more time, but this is my general inclination. I'm happy to participate in other questions. Thank you.
Thank you so much, Hussein. My next question goes to Tamer. Tamer, what is your opinion? Are Egyptian investors interested in using innovative finance models such as the ones presented? And also, from your point of view, which ones of them are the most attractive for investors?
So first of all, thanks, Luca, for giving me the opportunity to join such a fine panel. And really intrigued by the earlier presentations. Most of them struck many chords of things that we see every day. As you mentioned, our fund, the Acumen Resilient Agriculture Fund, invests in Africa. Actually, we are focused on promoting climate adaptation for smaller farmers by investing in innovative business models. And if you look at the Egyptian ecosystem, of course, it's right now it's buzzing. Everyone is following the news, and it looks like Egypt will become the #1 country in Africa receiving VC money by the end of 2021 for the first time. However, it's still, the ecosystem is still evolving. If you look at even like basic instruments like venture debt, it's not readily available like in other parts of Africa. And if you look at innovative instruments that excuse me, that we heard earlier, like de-risking by mixing commercial and mission-oriented capital, as Gavriel pointed out earlier, you'll realize that the market in Egypt is more than ready. As a matter of fact, we hear now that there are funds that are being formed to just focus on quasi-equity kind of instruments like revenue sharing or EBIT sharing with either a target return money, multiples, or IRR, whatever the structure is. But we see it happening, and it's a very powerful tool, as we heard earlier from Lewam, how it serves both interests of investors and of companies as well. But definitely, the Egyptian market needs more. We also we want to see more of blended finance, not only on the offering side, but also on the financing fund side, because I can speak of our fund where we blended all sorts of sources of finance, from commercial to first loss to philanthropic, not only to build the fund, but also to build a TA facility that supports the fund, which is a very powerful tool when you have a TA facility that offers those startups grants to do things that they realize how important they are, but they don't have the cash to do, like building proper ESG policies, like building proper, like having a proper ERP system, stuff like that. So it is the time for these kind of tools and innovative, blended finance, revenue sharing, EBIT sharing. Crowdfunding is definitely a very powerful tool. However, it's not one size fits all. And for some sectors, crowdfunding, we have seen in some parts of West Africa, we've seen startups, disappearing overnight because of just a bad season, for instance, and then they have to pay back. This is crowdfunding. You have to pay back your debtors or those who provide you with the crowdfunding. So again, we have to be flexible when we think of innovative financial instruments, because it depends on the market. And definitely revenue sharing or EBIT sharing is one that the Egyptian market is more than ready for. And as I mentioned, we hear that there are funds that are being formed just to focus on that instrument. Thank you.
Thank you so much, Tamer. Mostafa, my question for you, from your point of view, what is needed that Egyptian investors can deploy more innovative financing? For example, changing regulation or any other things?
Thank you, Lucas. Pleasure to be with all the teams in here. I think there are a few things that need to exist for these mechanisms to be applied in mass. First thing is of course regulatory is important, and there are regulatory actions that are being taken right now to regulate crowdfunding, all sorts of models of crowdfunding by FRA. There are existing discussions on this new regulatory framework, and it's supposed to show in the first quarters of 2022, hopefully. But that's one element. The most important part in my view is to look at the real engines behind how to activate such models. I'm seeing this as an equation like 1 + 1 = 11, because it's different from what a typical investment fund would do, or a typical bank would do, or a normal investor would do. So it's the mixing of these kind of mechanisms into what I call coordinated proactive measures or investment kits, things that can be approached in an easy way that reduces the need for human interaction and discussion on every opportunity, on every case, and sizing this opportunity here and there, and it takes forever, and many times the deals do not close when you have so many stakeholders that need to negotiate with each other. So this needs to be structured and coordinated as ready-to-use vehicles. I mean, the ideal, let's say, the go-to-the-moon scenario, it's like you just need to have a catalog, an online catalog of what kind of options are you looking for, and what kind of possibilities that are out there, and a matchmaking scenario for this. And the nice diagram that you have developed in your report that shows who are the stakeholders and who are the beneficiaries of these funds, start the exchanges via such kind of mechanism. So this kind of easy configuration tool is, I think, it's vital for fast tracking access to innovative financing models, because it's really tough for any startup to spend part of its time, keep running after this and this and this investor and discussing with this, and sometimes those are not interested, those are not serious, but it's better to make everything clear from the beginning as to how these things can auto-blend or auto-syndicate or auto-hedge without the need for a human discussion on every little piece. So I think that is, and this can actually be designed in a sector-oriented fashion, because you cannot just do everything all over the place right away. I mean, we know agriculture, for example, can take a specific route. These are the type of projects that exist. These are their typical needs, and these are the investment vehicles that can enable them. So we focus on this, and we develop the right products for them, and launch, and then go to another sector. I think these kind of vehicles can be approached and can be done. And also we can utilize existing regulatory metrics or rules. Like we have Islamic financing, for example. It's very similar to RSA, a revenue share agreement. But it's a discussion with a couple of banks who are providing this kind of service. But the RSA can be improved and launched on a much wider scale based on an existing regulatory framework without waiting for a new law to be issued. For example, regarding crowdfunding. Well, we all crowdfund one way or another. If you go invest in an investment vehicle in a bank, for example, this I put some money and the bank will take it and invest it. So we can use intermediaries to even initiate activities without waiting for the regulations. Let the regulations come. So I know it's not straightforward, and it's the world, but this is how the world is. It's a complex maze, and the best thing is to utilize what we have on the ground and connect the dots in a clever way, and launch products, make them visible and accessible, and this will actually facilitate the regulator's life, because now they have clear way as what is happening. Otherwise, it's also a pain on the regulator's side as to predict exactly how the market would respond to this new regulation. So anyway, that is just maybe a starting point for a discussion. But I really enjoyed this webinar. I learned a lot. Thank you so much.
Thank you, Mostafa. That's really kind to hear. So I think we have time for maybe 1 or 2 questions with short answers from the audience. Ann-Kathrin, is there anything from the audience?
Yes, thank you, Lucas. And so to the rest of you who will not hear your questions here, we will take it upon us to coordinate with the panelists to see if we can answer your questions in a follow-up email instead. So don't worry. So the question here will go to Lewam. So Tamer mentioned that Egypt is now ready for revenue-based financing. So what would your advice be for investors as well as for startups that wish to apply this model?
Sure, happy to take that question. I think one thing we all, because we all have the same end goal, right? We want the ecosystem to grow and prosper. So we all want to avoid, doing, mistakes that other markets did, where, at the beginning, we go crazy, investors asking for 10% of revenues, and for instance, just an example, and when that happens, it doesn't serve anyone's best interest. Yes, the investors might make some money, but in most of the cases, the company won't live long enough to deliver good returns, and then you lose a potential of a good company. I think investors need to look at other markets and see, okay, what is working. If it's more like the 3% or 3 to 5%, okay, let's start with that. Let's start with where others ended. Like Lewam mentioned earlier that, if I remember correctly, that they charge something like 3 to 6% revenue shares, which is pretty standard in Sub-Saharan Africa, or most parts of Sub-Saharan Africa. So we need to start from that point. We need to be able to take risks, also both sides, and believe that no one is into it to just make money and leave the other side without reaping benefits as well. So I think slow start is important, and a reasonable start, and to manage expectations, because it's a new tool, and usually people are concerned when they hear something new. We have seen it also. We have seen in some deals that we did in our fund, where we mix the revenue sharing with a warrant. So this way we can have a lower percentage of revenue sharing, but we can have the upside when it comes to having a piece of the equity when things go really well. So again, not only start slow, but also be innovative when it comes to mixing instruments as well. I hope that answers the question.
Thank you, Tamer. Lewam, you want to add something?
It was difficult to hear the first part of your sentence, Lucas.
Sorry. Thank you, Tamer. Lewam, you want to add something?
Oh, yeah. Thank you. Yeah, I completely agree with what Tamer mentioned. I think exploring different addendums and different ways you can make revenue share flexible. We've actually done some upside sharing on a few of the revenue-based investments we have deployed, so that makes a ton of sense. I think when something is new and there's a lack of familiarity, then it gets really, really challenging, which is why we, unlike some people that do revenue-based financing, we sort of do it on a more flexible time horizon schedule and until we get to a certain multiple, because it just creates like transparency and ease on what the expectations are on both sides of the table.
Thanks. Ankatin, I think we would have time for one last question from the audience.
Thank you. This one goes to Etienne. It's similarly, what would your advice be for development actors and financial institutions if they were to collaborate on exploring the sync model, or a similar model as you in AceliAfrica have implemented here in Kenya? What would your advice be to start that journey?
Yeah, thanks for the question. So definitely, like we did, the first thing is to understand the problem and in the local context. I don't think necessarily the study and the findings in Sub-Saharan Africa would, show the same challenges or the same magnitude of the same challenge in Egypt. If that's understood, that's one. Number two is to also identify which, of course, partners. It could be financial institutions, either on the debt side, also equity side. As I mentioned, this can be addressed in many ways. That's number 2. So, and then 3, the parties together can design the solution. So what happened here is we did not just find or do the study and go ahead and design the solution. We involved the potential partners. We brought institutions, learning institutions in a room. We met several times. We brought donor partners to the table to discuss and present what it is we are thinking about. And we made several tweaks to what originally was going to be the solution. And so once all the parties are aligned, then it's actually easier to deploy the solutions and get some quick buy-in. Yes, so I think in short, that's what I think would possibly make it work in Egypt pretty fast. Of course, we are here to share our models, we are here to share our learnings if you are kind of customers to the Egypt context.
Thank you so much, Etienne. Thank you, Anne-Catherine, for managing the Q&A. And as Anne-Catherine mentioned, after the webinar, we will be in touch. We will also make sure to provide you with the contact details of our presenters and panelists, so that afterwards, if you want to have more details or continue the discussion, feel free to reach out to them. So we are almost at the end of today's webinar. I'm handing over again to Dr. El-Raghy for her closing remarks.
Thank you very much, Lucas. Thank you to all our experts today. And really, it was an amazing webinar. I think we all were very happy with the recommendations that were put forward, and particularly hearing from practitioners that have used these mechanisms on the ground. Lucas, as he said, will share with us the emails, and as soon as the study is finalized, we will share it with all of you. On another hand, I would also like to mention that in today's webinar, we have some of the entities that are related to the regulatory body in Egypt. So we have someone from the Financial Regulatory Agency. We have colleagues from the Micro and Small Medium Enterprise Agency. We have colleagues from the Credit Guarantee Company, and also someone from the Egyptian Banking Institute. So I'm hoping that this is just the start of something that is much bigger, and that we will, inshallah, in 2022 see some new innovations in this area. So just to close off, thank you very, very much, everyone. Please feel free to share any more questions that you have. We will, under Tanmaya Tatweer project, we will make sure that we share the documents with you and the presentation. And have a fantastic day. Thank you.
Thank you so much, Dr. El-Raghy. Also from our side at iGravity, thank you so much for your participation. Thank you so much to our experts and panelists for their time. We can only repeat what was said. We also hope that this was only the start to a very exciting journey of innovative financing in Egypt. Thank you so much. Have a great rest of the day and see you soon.